Let's go ahead and talk about our last stock we're going to talk about today, which is Plains All American Pipeline, ticker PAA. And it's exactly what it sounds like. It's a pipeline company that's all American. It's all in North America. They own gathering terminal and storage facilities in California, Louisiana, Oklahoma, Texas, and in Canada, they're in Alberta and Saskatchewan. Yields about 5.2%. Has more than 90% of its cash flow tied up in long-term contracts. What stands out to you about Plains All American?
Plains All American, even though you mentioned how diversified they are, they're really a Permian Basin story. They've got one of the best positions there in the Permian, and they've got a lot of growth projects in the pipeline, so to speak. They just finished the Sunrise expansion pipeline. That's taken crude oil up to Wichita, and then it's going to go up to Cushing, which is kind of the nation's oil hub. Mm-hmm. Then they have another one that's the Cactus II pipeline. It's an expansion of another pipeline that'll take oil to Corpus Christi, Texas, which is a big hub down along the coast. So they've got these projects, and they've got a lot of other little, they call them debottlenecking projects, to look for, there's too much oil flowing in one direction. So how can we fix that and invest in capital and get a return and improve the flow of oil? So they're really focused on the Permian, which is a great place to be. It's growing, it will grow so fast once they get these pipelines online the next year.
Yeah, Matt. And, we've talked about the Permian in the past, about, the pipeline constraints there and how it's really kind of held back production in that region. As these pipelines come online, so a couple questions here. First, because there's a shortage in pipelines, what kind of leverage does Plains All American have, in negotiating pricing with the producers there? And then secondarily, as these pipelines come online, how quickly is their capacity going to get filled up and we, reach another bottleneck again? Because there's a massive number of drilled but uncompleted wells, this kind of latent demand in the Permian. What are your thoughts on those two kind of questions there?
Well, one of the things that the pipeline crunch has kind of enabled Plains to do is be able to secure partners. They have this partnership with ExxonMobil. It'll be kind of the next Permian pipeline that will probably be built. And Exxon signed a big long-term contract to be an anchor shipper on this pipeline. And the pipeline companies have been able to do that, is get big producers to kind of anchor these pipelines. And that, it de-risks the project so that smaller producers are okay with signing on with them. So that's kind of helped them plan ahead and get the next ones lined up. So this pipeline, it'll probably be like a 2021. And so now they're starting to get ahead of the curve. I think there's 3 pipelines that are supposed to be finished by the end of next year. And then Energy Transfer and Magellan, they've got a pipeline that's coming 2020. So they're basically staging them almost every year, and that should help them get ahead of the curve, as long as there's no permitting issues or other problems like that. So it's really helped them to just be able to get producers to focus on, I need to sign on now so that I can grow later.
Right, because if these producers, it's the problem they've been having now. If they don't have some kind of pipeline deal to get the oil out, I mean, it's a useless asset. I mean, you're selling your oil below the spot price and all those sorts of things.
Right.
Let's talk a little bit about too, that we're seeing Plains All American, building out all these new pipelines. They've also, sold some of their assets. They sold, I guess, their BridgeTex asset, 50% stake in that to Magellan Midstream Partners. They're going to use that cash to kind of delever a little bit. What's their balance sheet looking like at Plains All American, and what's kind of the prospects for that going forward?
Yeah, that's been the driver. They sold a lot of assets in the past couple of years because they, like a lot of companies, had a little bit too tight when the oil market crashed. So they've been trying to get that leverage ratio down. They expect to hit their target early next year, and that's going to free them up to do some other things. But and that's where, like in the case of BridgeTex, they didn't sell the whole thing; they sold a part of it, so they can still keep that. But there's kind of a disconnect in the market where Permian pipelines are selling for ridiculous prices. So they're cashing in on that and then using that cash to build new Permian pipelines for a really good rate of return. So they're kind of making a really good trade there. And, then as these pipelines come online, the cash flow will go up. It's already starting to happen this year, and they're projecting, I think, 12% growth next year. So you have this growing cash flow stream coming at a time that their balance sheets are getting better, and that's going to free them up to start increasing their distribution probably next year. They're talking with their May payout that they'll probably increase it, and they could do any number of things. They're going to be covering their payout by like 190% this year, so it could go up substantially, or they could hold some back so that they can build some of these projects. We mentioned the Exxon pipeline that they're trying, so Exxon's going to help fund that. They've got another joint venture partner there. So as they secure more joint venture partners, it's less capital they need to put up, and that's more potential growth for the distribution. So that's what I think is interesting about them is this they're heading into this period of growth. Their balance sheet's getting better. And, they're pretty cheap. So it's a really interesting company.
Yeah, Matt, I mean, all these things seem to be lining up. I think, anybody can tell there's a, massive shortage of pipelines in the Permian and that there's going to have to be investment there over time. I guess what would have to occur to kind of disrupt this thesis for Plains All American and really all the pipeline players, supplying into the Permian? What would have to occur for that kind of direction it looks like we're moving when it comes to pipeline demand there for that to be disrupted?
Well, all this oil is flowing to the Gulf Coast, and which is good because there's a lot of refineries there, but there's only so much that the refiners can handle. So some of the companies, oil companies, are kind of concerned that they call it the WTI Brent spread. So WTI is West Texas Intermediate. That's kind of the domestic oil price, and Brent is the global oil price. So there's a $10 a barrel difference, and they're worried that that's going to widen. And so unless you have access to exports and can sell your oil at Brent, then, it's the same thing with producing in the Permian now. You're selling at a discount. So unless companies start building more export capabilities or more refineries get built, then we're going to be in the same trouble. At $10 a barrel, and there's the U.S. produces 10 million barrels a day. That's $100 million that they're potentially losing out with these pipeline issues and this infrastructure issues. So one of the things Exxon's looking at doing, and that's why they're partnering with Plains, is they're looking at building a new refinery or expanding a refinery. So that'll, Exxon will have this, cheap source of oil that they'll be able to refine and make more money. So you'll see these kind of downstream investments where companies will look at how can we make money on this discount? Are they going to build export terminals? Are they going to build new refineries? So that's kind of where the focus needs to be, is how are they going to use this oil now that they're producing it?
Sure, Matt. And maybe you answered my question then. So, I mean, of what people should watch if you're going to start a position in Plains or kind of, monitor it going forward, is that refinery capacity the thing that you should be really paying attention to, like kind of downstream, or what are the things that investors really should focus on to make sure that growth story is still playing out?
Yeah, that's part of it. Like the nice thing about a company like Plains is they already have long-term contracts for the pipelines that they have, so they pretty much know where that cash flow is coming from for the next couple of years. It's more of where's the growth coming after 2020 in this case. They're pretty confident that they're going to build this pipeline with Exxon. There's another pipeline that they're looking at up in, I think it's Oklahoma. So and that'll move oil down south as well. But it's like, where's the growth coming next? They know the Permian is going to keep growing and growing and growing. But if we're not going to be able to get that oil to global markets, then the growth is going to stop because it won't be profitable to produce. So yeah, I would also pay attention to what's going on downstream. Look especially at export capacity. There's a lot of companies that are trying to do that. Phillips 66, and it's MLP. They're building some export capacity along the Gulf. So that would be something I'd pay attention to.
Okay, Matt. And then last question going away. This is general market. But if we come back and record this podcast 3 years from now, do you think there will still be pipeline constraints in the Permian?
In the Permian, probably not. It seems like they might actually overbuild at this point. Just the amount of pipelines they're doing now, and private equity companies are also involved in there, and they tend not to. They'll build more on speculation than a lot of the publicly traded companies. So I wouldn't be so worried about the Permian, but we might run into pipeline issues elsewhere, or like I mentioned, just so much oil flowing to the Gulf that they just can't handle it.